3 weeks ago, the Federal Reserve changed one line in their monetary policy statement. Financial media ignored it, but institutional investors immediately moved $400 billion. Welcome to Bull Bucks, where we decode the mechanisms, the 1% deploy, while the 99% stay distracted. Here's what happened while everyone was watching stock market headlines. The Fed subtly shifted language around inflation targeting. Sounds technical and boring, but what it actually signaled was the beginning of the largest currency devaluation event since 19. Let me show you what's unfolding right now. When the Fed says inflation is transitory, they're not describing reality. They're managing expectations. Because here's what the data actually shows. Real inflation, measured by the cost of food, housing, energy, and healthcare, is running at 12 to 15% annually, not the 3% they publish. The official numbers exclude the things you actually need to survive. B. Design. This isn't measurement error. This is monetary policy theater. But here's where it gets critical for 2026. The Fed is trapped. $11 trillion in US debt matures and needs to be refinanced in the next 18 months. At current interest rates, the interest payments alone would consume 40% of tax revenue. Unsustainable. So they have two options: default or inflate the debt away. They chose inflation. And the signal was in that one-line policy change 3 weeks ago. What does this mean for you? Every dollar you're holding is being deliberately devalued at roughly 10 to 12% annually. Your savings account, paying 1% interest, you're losing 11% in purchasing power every year. Your salary that feels stable, it's buying 15% less than it did 2 years ago. And by 2020, if this trajectory continues, you'll need twice as many dollars to buy the same goods. This is the hidden tax nobody votes for but everyone pays. Second mechanism: asset price inflation versus currency devaluation. When the Fed prints money, it doesn't flow evenly through the economy. It goes to assets first. Stocks, real estate, commodities, Bitcoin, anything scarce that can store value. This is why the stock market keeps hitting records, while regular people feel poorer. The currency is being devalued, and those holding assets are being protected, while those holding cash are being destroyed. The wealth gap isn't about income anymore. It's about asset ownership versus currency dependency. Third mechanism: the commercial real estate collapse. Nobody's pricing in $15 trillion in commercial real estate debt. Office buildings sitting 40% vacant. Work from home isn't temporary. It's permanent. Banks holding these loans, regional banks specifically, they're sitting on massive, unrealized losses. When these loans start defaulting in late 2026, early 2027, it triggers another banking crisis. Deposits get frozen. Bail-ins start. And everyday savers lose access to their money while institutions get bailouts. This is a 2026 trap. Currency devaluation on one side, banking instability on the other. And the middle class gets crushed between both. Here's what separates the 1% from everyone else. They saw this coming 18 months ago. They've been moving out of cash and into hard assets. Real estate in markets with supply constraints. Precious metals, inflation-protected securities. Bitcoin and crypto with verifiable scarcity. They're not worried about inflation because their wealth isn't denominated in currency. It's stored in assets that appreciate as the dollar devalues. But here's the timing window most people will miss. Right now, in Q1 2026, we're in the calm before the storm. Asset prices haven't fully adjusted yet. There's still a narrow window to reposition. By Q3 2026, when commercial real estate defaults accelerate and the Fed is forced into emergency measures, asset prices will spike and access will tighten. The window closes. Real example: Venezuela, Turkey, Argentina. Every country that tried to inflate away debt followed the same pattern. First, slow official inflation, while real costs surge. Then, loss of confidence. Then, rapid currency collapse. Then, capital controls preventing people from protecting themselves. The US isn't immune to economic physics. We're just bigger. Which means, when it breaks, the impact is global. Here's the sovereign move. If you're holding significant cash, you're holding a depreciating asset. Convert two things with inherent value or scarcity. If you're planning major purchases, accelerate them. Lock in today's prices with tomorrow's cheaper dollars. If you're earning income, negotiate inflation-adjusted increases or shift to equity compensation. The goal isn't to time the market perfectly. The goal is to not be the last one holding cash when the music stops. Because here's the truth about central bank policy. They don't work for savers. They work for debtors. And the biggest debtor is the government. Your purchasing power is a release valve. they use to manage their debt problem. This isn't conspiracy. This is documented monetary policy going back 50 years. If this intelligence changed how you see your savings strategy, hit that subscribe button. Bold Bucks releases one video every week exposing mechanisms most people will never discover. We're not here to predict crashes. We're here to show you what institutional money is doing right now while retail waits for headlines.